Okay, hi everyone. Let's look at exercise 7-14 that you can see on the screen. And this problem is essentially going to ask you to read some information about the accounts of the Hulse company, and then you've got to compute the January 31st balance for 5 accounts: accounts payable, accounts receivable, cash, inventory, and sales revenue. Okay, so if you look here, one thing that you see is they provide us with the individual balances as of the January 1st, and we're going to try to compute the balances at the end of the year. Alright, so let's focus on accounts payable first. The beginning balance is $13,112. Then they give us some facts. I'll move my mouse off to the side so it won't disturb you. Now remember, accounts payable is used essentially to pay for goods that we receive on account, right? So we get legal title to goods or services in exchange for our promise to pay for them at some point in the future. Alright, so what does the first information underneath the table tell us? It tells us that, it says that Hulse's sales journal for January shows a total of $111,245 in the selling price column, and its one column purchase journal for January shows a total of $77,610. Okay, so to understand what's happening here, you need to understand what a sales journal shows. It shows the sales that the company would have, and it's a one column purchase journal. Excuse me, it will show the sales, and in the sales journal what that would represent was sales that were made, usually on account. In fact, if it was in a cash, if the sale was made for a cash payment, that would appear in a cash journal. Okay? Probably a cash receipts journal. And they also say there's a one column purchase journal for January shows sales of $77,610. Now the purchase journal, remember that one column represents a debit and a credit. It represents a debit for purchases, and it will describe what it's used for. Typically, if we're selling items, it's probably inventory. But the credit side of the purchase journal is going to show how much accounts payable increased. So we're going to need that. At $77,000 shows additions to accounts payable. All right, what do our other pieces of information tell us? They tell us that the column total in Hulse's cash receipts journal, see, now we have cash receipts, and we have a column for each account that would be used. So we had a total cash debits of $61,591. That represents the actual cash payments that we received. Discounts of $12.79. Now that's a debit. That's a reduction from sales. That's where customers took a discount, and we have to show that the sales value decreased by the discount. Accounts receivable shows us that we're reducing accounts receivable when the customer pays us by $45,211. The sales revenue, where sales were made for cash, was made in the amount of $6,653, and then there was other accounts, $11,006. Okay, the next note says the column totals in Hulse's cash payments journal, this represents cash payments, were $55,229. That's a credit, right? Cash we actually spent. There was a credit to inventory of $2,914. Accounts payable debit of $45,453. So that would represent any time we actually reduce the accounts payable, and other accounts $12,690. Now the last comment they tell us is accounts payable, accounts receivable, cash inventory, and sales revenue are not involved in other accounts. So that means we get to ignore our other accounts column. These accounts aren't impacted. And then you need to compute the January 31st balance. So based on this information, what we do know is we started with $13,112, and then we have to look at this information and figure out what increased accounts payable and what subtracted it. Okay? So accounts payable would represent what is owed to others, and we would want to look and see where was it increased and where was it decreased. Okay? So the cash payments shows us where it was decreased, and the sales journal would show us where it was increased. Okay? Now, for accounts receivable, we're going to start off with that beginning balance, and then we're going to look at the data and try to figure out when was it increased and when was it decreased. So what do we see? Total of $111,000 appearing in the sales journal. Now remember, the sales journal is a one-column journal. It represents sales that would be a credit and a debit to the account that you would use to show accounts sold on open account to your customers that you made, and then they're going to have to pay for that at some point in the future because it was made on open account. Okay, and then the cash receipts journal shows cash that was collected, and there's a column for each account where there's a reduction in the balance because cash was collected. Okay? Now, cash is real straightforward. You're going to have to start off with the beginning cash amount and then show with the information provided when cash was increased and when cash was decreased. With inventory, we've got to start off with that $14,225, and then we need to show all the places where inventory was increased and where it was decreased. The one column purchase journal shows a total of $77,610. Now remember, if it's a one column purchase journal, the assumption is it's a debit to inventory and a credit to accounts payable. Okay? I think they told us we had an inventory credit, so there's a reduction of $2,914 from the cash payments journal. And we've got another impact where they talked about cash. And we've got to find that too. Okay? And then finally, sales revenue, we want to show what the sales were. They don't have a beginning balance because sales is a temporary account that appears on the income statement. It wouldn't have a beginning balance. And so what we have to do is look for all the places where there was sales being recorded. Right there's one place where sales increase. And there may be another as well from one of the other journals. Okay, so that's some hints to help you work through this particular exercise, and I hope you find this beneficial.